Markets are bleeding red again and investors are getting nervous, but while fear is rising, opportunity often does hide in the panic, and today we're breaking down 5 beaten down stocks that might just be worth a second look if you're brave enough to buy when others are running. A few other things we want to cover in the episode today: why Apple is down nearly 3%. We're going to discuss Amazon, which is under the spotlight, also down although marginally, and Intuit, one of the bright sparks of the market today, up more than 9%. And we'll also touch upon the financial service industry, a bit of news for Visa and MasterCard, which is definitely worth noting. Now first, let's take a look at understanding what is happening with Apple, a company that typically doesn't move that much on any given day. And we can see Donald Trump is threatening a 25% tariff on Apple iPhones if they are not made in the US. This is something we have heard continuously being mentioned by the Trump administration, so maybe this is actually something that will come into fruition much sooner than we anticipate. And he goes on to say, I have long informed Tim Cook of Apple that I expect their iPhones will be sold in the United States of America. They'll be manufactured and built here, not in India or any place else. So clearly this is an issue that Donald Trump really wants to get resolved. He does not want to see Apple products made anywhere other than the US, and he's threatening them, saying if this does not happen very soon, he will put in place a tariff of at least 25%, and close it by saying thank you for your attention to the matter. Now this is something that is really concerning, not just for investors of the company, but also in fact consumers of Apple products. Bear in mind, manufacturing isn't done in the US because it is a lot cheaper, and therefore consumers can buy their goods at the current prices. If they do ultimately bring them into the US, we wouldn't be surprised to see some very large increases on all of your favorite products. So we'll see whether or not this is something that does happen. The company, as we can note, down nearly 3% on the day. Over the last year, it is up around 3%. Year to date, this company has been battered down 22%. They've lost more than 1/5 of their total market cap in a matter of months. No surprise though, longer term investors still up significantly, over 500%, outperforming the S&P, and it does trade towards the lower end of the 52-week range. Not quite there yet though, that's the $169 mark, and we can see for quite some time Wall Street have been the only ones who believe that the company as of today is in fact to buy. And whilst we won't do a detailed analysis like we typically do on the channel for the company, we can see their forward P pretty much sits in line with their 5-year average. That is the same to be said for their dividend yield. Both of these signs telling us that Apple as a whole is reasonably valued, and that's also confirmed when we take a look at this methodology, which is a blue tunnel which signals the expected fair price of the company, and we can see the current trading price sitting bang in the middle. Again, another indication, like the two previous, that Apple as a whole is reasonably valued. And for those who are interested in our own intrinsic price, we see the company fairly valued at the $200 mark. Given it is slightly below, we would say it's trading around its fair price, and we've derived this from the DCF model. As you can in fact see here, we have the growth rate of 8%, and typically on the channel, whilst we have a low, medium and high, 8, 10, 12 respectively, we would use the medium of 10%, but for Apple, we just haven't seen any growth catalyst that would make us even believe they can achieve the 10 to 12% rate, and based on that, that is how we end up with our intrinsic price, and as we said, we see this as fair value. Wall Street, on the other hand, with their buy signal, see this at $230, upside of 17%, and for us to really get excited, we would need a margin of safety at 10%, a buy at $180, not something we would consider in all honesty at that point. 15%, 170, again, not one for consideration, but if we get a 20% margin of safety towards the 52-week low at $160, this is where we would personally consider adding Apple. As always though, give us your thoughts. This was just one piece of news today, and in conclusion, we see this now even with the drop and near the 52-week low at its fair price. The other bit of news which really did pull the market down, at least on the open, was that Donald Trump has said 50% tariffs are going to be put in place on EU imports from next month. Not something investors want to see. We've moved on from the issues of Liberation Day, but everything isn't coming as planned. There are no talks that are being agreed, at least between the EU and the US. unlike other countries that we are led to believe, for example, US and India, that they are very close to agreeing on a deal. We can see here Donald Trump has said our discussions with them are going nowhere, and therefore I am recommending a straight 50% tariff on the European Union starting June the 1st, so we're just talking a matter of days, and this is something, as we can see here, would be more than double the tariff rate for the US that was previously announced. So again, this is something that's really ramping up. Investors are starting to get a little bit worried now, and that is reflected on the down day we are having in the market. Now, it's by no means the massive drops we have seen over the last few weeks, but this is perhaps one way it could start if you are one of those that believe we are going to see significant downtrend at least in the next few months. Another sign to flag is treasury yields. Now, we can see they're not near that high level point that we've seen over the last few weeks above the 5%. Nonetheless, they are still very, very high, and we do like to track these. It is very crucial. They directly influence borrowing costs across the economy, including mortgages, corporate loans, and stock valuations. They also serve as a key indicator of investor sentiment on inflation, interest rates, and economic growth, so definitely something we would say to keep an eye on. And just when you thought the volatility may in fact stop, next week we are perhaps getting the largest earnings for this season. That is Nvidia. They will be releasing their numbers for the latest quarter, and we can see amongst the wider economic impacts of the tariffs and the other things we've just touched upon, the company is down around 2%. Very minimal for this company, which just in the last month is up 26%. In fact, it was trading near its 52-week lows below the $100 mark, but all eyes will be on their earnings, which is anticipated next week, and we can see Wall Street sticking firm with their strong buy rating alongside Seeking Alpha, who also believe this is a buy in the portfolio. Now, if you missed our episode from earlier today, Bill Ackman has now announced a new position. Maybe a surprise, maybe not, but that is in Amazon, which will be in his latest quarter, one of, if not his largest positions. He did buy during the Liberation Day drop, and to fund most of this move, he has in fact fully sold out of Canadian Pacific. Again, if you want more information on Amazon as well as the analysis behind the move, do check out the earlier video. But we can see upon market open, it is down, although minimally around 1%. A company that is up more than 10% over the last year. Year to date, down around 9%. Massive outperformance again of the S&P, similar to Apple, trading around the midpoint of the 52-week range. But unlike Apple, where we only saw Wall Street with a fairly weak buy rating, we get a strong buy from Wall Street and Quant, as well as a buy from Seeking Alpha, one that many analysts do believe there is quite a nice bit of upside. And then also worth highlighting the news that has come out today that does affect both Visa and MasterCard. The European Union is once again scrutinizing both of these companies over their scheme fees, questioning whether retailers truly benefit from or in fact have alternatives to these charges. Regulators at the moment, they're gathering information that could lead to a formal antitrust probe, potentially resulting in fines of up to 10% of their annual revenue, and this renewed attention follows broader concerns about Europe's reliance on foreign payment systems and past actions that have ultimately led to significant fines as well as fee reductions. Again, something just a flag, although they only dropped fairly marginally, and that you could argue is due to the wider overall market. And finally, we have that one company that did stand out, very green, Intuit, one we've actually talked about quite often on the channel. It is a fairly strong company, although we did prefer it much more when it was trading near its 52-week lows. But we can see up 8% over the last year, year to date up 15%, and again, like the previous companies we've discussed so far today, another outperformer of the S&P. We're still both Seeking Alpha and Wall Street calling this company a buy. And if you wanted to see the reason for this, well, they did have their earnings. We can note here they did outperform Wall Street's estimates, as well as issuing strong guidance, something you really would like to see as the dream scenario for any of your stocks in your portfolio. Not only outperforming analyst targets, but also issuing strong guidance. That is pretty much the best case scenario. As we can see, fairly substantial beats, 1165 versus 1091, and on the revenue 7.8 above 756, with also a fairly strong guidance expectation, which analysts always love to see. Having said all of that, we are still sitting in greed, so investors clearly aren't massively phased at the moment for the drops we've seen in the market. Perhaps they will buy the dip, perhaps we will in fact end the day in the green. Not something that would be surprising, but definitely worth considering all these different factors, and in particular that tariff volatility. But as we said at the beginning of the episode, we want to have a quick look at 5 beaten down stocks that perhaps might be worth a second look. And the first one is PepsiCo, one that's trading at $128 at their 52-week low, down 30% over the last year. Year to date, down 16%. Over the last 10 years, even underperformed massively the S&P, up only 33. Even if you were to reinvest your dividends, you still would have massively underperformed. Massive pullback from 52-week highs, over $181. And we note every single analyst, Seeking Alpha, Wall Street and Quant, all call this company a hold as of now. Yet if you were to look at their forward P sitting at 16, well below the 23.9 5-year rolling, this is the lowest it has been as well over the last 5 years. Purely on this is what we would say to be severely undervalued, coupled with the fact you're getting yield around 4.5%, not only above their 5-year average of 2.9, but also the highest they have offered to shareholders, at least within this 5-year data set. And again, similar to looking at that methodology we had a peek at for Apple, this company below the bottom end of even the blue tunnel, massive disparity, again severe undervaluation, and it's pretty much been trading at that undervalued level at least over the last year. We also want to flag their dividend safety score does sit at 93, very safe, very important for a company that has been pummeled hard like PepsiCo and the yield that is being offered. However, I do want to make it clear there are some issues with the company that you need to factor in, at least at the bare minimum, into your margin of safety. That is their free cash flow payout. We want below 70% for consumer staples. We can see this fairly consistently very high, 102% in 2024. This is what we would call a red flag indicator, meaning they paid more, in fact, in 2024 in terms of dividends than generated from free cash flow. However, what we would say, if they can hit the expectation of the drop to 76%, that will alleviate some of the issues we do anticipate for the company, but definitely something we have to flag for those that are considering. And in terms of the growth, they do get a D. Revenue year on year pretty much flat, the same to be said forward looking, and we can see sector median not much better in the low single digit. However, over the last 5 years, they've been growing their revenue in the mid single digit region, also expecting very minimal in terms of EPS moving forwards, 3.4% below both sector at 6 and their own 5-year of 7. However, out of the next 4 quarters, they do anticipate 3 of them to be growth. They have a 75% track record, 3 out of 4 beats. Most recent quarter, they missed, although marginally, by 1 cent, 15.41, based on an EPS estimate of $8.44. Now, intrinsic value gets to $161, which is the average of these 3 that you see on screen. And as always, you can grab a copy of this model by clicking on the pinned comment below, running to your own numbers, whether it's for PepsiCo or any others. But 161, we do apply the margin of safety of 10%, buy at 145, and as we keep on going today, we're saying you're getting pretty much a bang on 20% margin of safety, whilst Wall Street themselves see this at $162 over the next year, in turn giving this 27% upside. Now give us your thoughts. 20% MOS, you're getting a 4.5% yield, very rare for this company, 27% upside. Is this one to now start considering, or in fact, do you believe ultimately with the issues surrounding the company and the things that affect it, maybe this isn't one to buy at all? We'll also highlight 25% would be a buy at 121, at 30 around 113. As we said, 20% MOS, 27% upside. In your own opinion, PepsiCo, buy, hold or sell. Now before we move on to the next one, just to let you know, we have released our latest free weekly article. We draw on every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month, lots of information as well as the upside that Wall Street themselves see over the next year. And you can also grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is UNH, which is pretty much flat on the day, and we've covered this extensively in terms of the reasons why it's down 43% over the last year, down 41 year to date. Over the last 10 years though, it still has marginally outperformed the S&P, up 147%. trading near their 52-week low, but what a pullback from their all-time highs of $631, and we still see both Seeking Alpha and Wall Street calling this company a buy. Very similar to PepsiCo, their forward P of 12.7, one of the lowest against the 5-year of 20.2, another severe undervaluation signal, coupled with the fact the yield of 2.83 is well above their 5-year of 1.42, again the highest they have pretty much offered over the period, and you're pretty much not surprised to see massive disparity between the lower end of the blue tunnel and where it sits. Again, severe undervaluation bells ringing for this company, but also understand that there are other issues surrounding this company given the drop we've seen, and if you do want to understand a bit more, then do check out our in-depth dive, particularly to UNH. Growth comes in at an F year on year and forward looking in the 8 to 9% region, which is above, although marginally, the sector around the 7 to 8%, and also not far off their own 5-year numbers. In terms of EPS, maybe a little bit of a letdown given it's expected to be 7% when the sector sits higher at 10 as well as their 5-year at 13.3, and they only expect one of the next 4 quarters to be growth with a 75% track record, very similar to PepsiCo. Their most recent one was a miss, trading on December 2026, forward P of 11.1. Now intrinsic value gets to $450, and look at the price difference, that is quite significant, so we are expecting a fairly attractive margin of safety, and as we keep on going today, you are in essence getting more than 30%, not at 35 just yet, but really not that far off. Again, you will need to take into account a lot of things surrounding the company, fairly similar to PepsiCo we would say, but 35% MOS, 35% upside. Wall Street see this at $400 into 2026, a yield touching the 3% point. Again, let us know. UNH, similar to PepsiCo, buy, hold or sell. We then move on to Nike, which is down around 2% on the day, down 34 over the last year. Year to date, down 21%. They've also lost a large amount of their market cap, 1/5 in just a matter of months. And over the last 10 years, they have severely underperformed the S&P, up 18%. All-time highs, you'd have to take a time machine back to November 2021 at $178 and probably sold it back then and considered buying around the point now. It is trading near the 52-week low, just one buy rating again from Wall Street, and worth highlighting the fairly recent news that they are returning to Amazon after being away for 6 years, coupled with the fact they are planning to raise their prices in the US due to the impact that they expect tariffs will have. No surprises given they do manufacture a lot of their products in the regions where some of the tariffs were hit the hardest. And looking at the forward P, it does still sit fairly high in comparison to their 5-year, but this is a company that looks to typically be trading above the 30 mark. You are now getting a yield of 2.7%, one of the highest, although at one point it was giving a 3% yield, but still well above the 5-year of 1.13. And according to this model here, we can see reasonable valuation, although it is towards the upper end of the blue tunnel. We do want to flag as well, not something we really like to see, the expected price decrease over the last year, essentially telling us this company is worth less and less as time has progressed. Again, something worth flagging. Growth looking terrible at an F, both year on year and forward looking down in the negatives, given the sector is fairly small, still positive at 2 to 3%, and their own 5-year sitting in the mid-single digit. EPS pretty much flat, again not something you really want to see. Sector sitting at 10, their own 5-year at 13, and only one of the next 4 quarters anticipated to be growth, although they have a 100% track record, trading in May 2026, forward P of 30.3. That is higher than the previous, and this is essentially noting here earnings per share is estimated to fall from the last year. Now our intrinsic price is around $80. Given the current price, again fairly attractive margin of safety, but will come down to what level you're looking for. We see pretty much 25% at the current price. Wall Street have $77 as their price target, upside of 28%, and this is one that Bill Ackman does still hold, whilst not in terms of shares in his portfolio, in terms of options, so he is still very bullish on this company. But give us your thoughts. Is this one worth considering? 25% MOS, 28% upside, a buy, hold or sell. We then move on to another beaten down company, Novo Nordisk, down more than 1% on the day, down 50% over the last year. They've lost half of their market cap in the last 12 months. Year to date, down 22%. Over the last 10 years, still somehow managed to outperform the S&P, although marginally up 138%. And we can see all-time highs around the $150 mark last year. Again, nice to have a time machine and sell at that point to consider buying now. We can see it's not far off their 52-week lows, and both Seeking Alpha and Wall Street call this company a buy. We also again see massive differences between the forward P of 16.4 and the average at 30.4. Again, another severe undervaluation signal. The same to be said on the yield, 2.4, well above the average of 1.41. Lots of signals that this company is perhaps a great opportunity, and that's also confirmed. And very interesting to note, unlike Nike, the actual expected price is in an upward increasing trend, something we always want to see. The actual stock price decreasing, this is honestly an investor's dream. Massive disparity between the points. Novo Nordisk, definitely one for consideration. Growth does come in at a C+, year on year 24%, forward looking 20 when the sector sits around 7 to 8, and is also growing faster than their own 5-year at 18 and 15% respectively. EPS 14% expected, well above the sector comparative at 10 and pretty much in line with their 5-year average. And over the next 3 quarters, growth is anticipated, 75% track record, but nice to see the most recent 3 quarters were all beats. Trading December 2026, forward P 14.7. Now our intrinsic value is $82 derived from the DCF model, pretty much the same as what we ran through for Apple. Now we have a growth rate of 14%. Remember, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Novo Nordisk or any others. But at 14%, we can see 22% upside, and you are getting a margin of safety. As we keep on going, essentially we see around 20% at $66. Wall Street very bullish, $95 over the next year, 42% upside. So is this one worth considering? 20% MOS, 42% upside. We'll also show you at the 12% rate that you are still getting a margin of safety, although not a massive amount. In fact, we see this at 5% for those that do believe it should be a lot more conservative. But again, let us know your thoughts below. We then move on to Adobe, which is also down like the rest of the market, just over 1%, down 15 over the last year, year to date down 8. Over the last 10 years, outperformed the S&P, up 418%, but all-time highs around 2021, the back end just under $700, trading near their 52-week low, double buy from Seeking Alpha as well as Wall Street, and a forward P sitting around the 20 region. Now, lots of things to love about this company. If we look at their buyback yield, it is incredibly high at 7.6%. We can see the amount that they are buying back of their own shares every single quarter. Very bullish. We love it. Essentially returning excess cash to investor pockets, and they're trading at one of their highest free cash flow yields, at least over the last 10 years, as well as trading at one of their lowest valuations on an EV to EBIT basis. But that's also reflective if we were to look at other valuation metrics, and they get a C on the growth, pretty much year on year and forward looking in the 10% region, whilst the sector sits lower in the mid-single digit, but they have been growing their revenue a lot faster over the last 5 years. EPS 15% over the next 3 to 5, marginally above the sector at 13.6, but marginally below their own 5-year at the 16% point. They also have green right across the board in terms of the earnings. First time we've seen this today, always great to see. Trading on November 2026 numbers at a forward P of 18.2, and our intrinsic value gets to $587. Now we have used a 10% growth rate moving forwards. You will get a fairly attractive margin of safety. As we keep on going today, 25% a buy at 440, at 30% is bang on where we see this company right now. Wall Street themselves, 518, 26% upside. Again, let us know, maybe this is one for consideration, or you believe AI is going to completely disrupt this company. Definitely one that does split the community. We'll also show you, for those that believe we should be extra conservative at the 8% rate, you are still in fact getting a margin of safety. Not as much as what we saw at the higher rate, but you're still getting 20% around $408, and as we said, upside 26%. Adobe, in your view, buy, hold or sell. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.